On behalf of Maybank Group Wealth Management, we'd like to wish you a Happy New Year and a warm welcome to Maybank Investment Outlook Webinar 2022. How will global GDP growth be in 2022?
So I think it looks like our Maybank forecast is pretty much in line with your views. We're looking at 4.5%. So that's a moderation from the 6% of last year. Still healthy, I think, by historical standards. But I think that headline figure kind of clouds what is a very divergent and uneven growth recovery. So I think this chart shows that when you look back, it's really the advanced economies that have led the recovery, US and Europe. But some emerging market economies, including here in ASEAN, has lagged behind. So I think we are looking for some emerging markets to catch up, partly because of the vaccine rollout and then the reopening of economies. So that will be an important thing to bear in mind. Bear in mind that this unsynchronized, this uneven global growth recovery is a challenge for central banks because it does mean that the guys that are ahead, like the US, is being forced to tighten earlier by the standards of those which are lagging. And that will tighten monetary conditions and could increase the pressure on yields, on exchange rates. So something to look out for. The second point is to highlight, in this neighborhood, is that we are looking for ASEAN's growth to actually be faster this year, in part because of the delayed reopening. We are looking that by April, 70% of the population across all ASEAN countries to be vaccinated, and that will provide the room for reopening. It is an interesting inflection point for ASEAN as well, because this is probably going to be the first time ASEAN's growth is going to exceed that of China, first time in 30 years. So something to watch out for, and some of the economies, our strategists, Eddie will highlight, to play on this recovery. China is slowing down, partly because of cyclical and structural forces. So I think you already heard, what's been going on, the tech crackdown, the move to slightly more socialist policies under the Common Prosperity, the tightening of the property sector. So we'll see how this plays out.
So will inflationary pressures abate in 2022? And what are the indicators to look out for?
I think you hit it on the nail. Like, inflation is the big question mark this year. Even when you look across the inflation picture across the world, it is also very lopsided. It is very high in the US, headline inflation 6 to 7%, just only starting picking up in emerging markets. The divergent and uneven inflation reflects the uneven labor market recovery, where wages in the poorer countries are still kind of low and still considerable slack in the labor market. But we are looking for inflation to moderate in the second half. Just bear in mind that commodity prices, some of the base effects will wane by the second half. It's much easier to imagine oil going from 40 to 80, but much harder to imagine oil going from 80 to $160. The other part of the picture is the global supply chains. And I think there are some signs that those bottlenecks seems to be easing. So when you look at the freight rates, for example, right, which have gone through the roof last year, shipping rates from Shanghai to New York went up 400%. But in more recent months, they've started to come off, by 10, 20%. When you look at the semiconductor prices, which face acute shortages just several months back, the prices have also been easing. So I think we hope that by the second half of this year, that would, inflation will come off, and that would take off some of the pressures from the central banks to tighten, and that should also take off some of the pressure on the bond yields.
And moving on closer to home, Singapore recovered strongly last year, and Maybank expects Singapore economy to expand 3.8% in 2022. So Harbin, can you share with us what are the key drivers for Singapore economy this year, and what are the key risks that we should be looking out for?
So Alexis, I guess you look back at last year, it's a pretty incredible year. Few would have expected that Singapore's economy could have grown at 7.2%. So I think moderating to 3.8%, it's still a pretty healthy growth rate. Just bear in mind that last year, the growth drivers were kind of uneven as well. It was really the manufacturing sector that went gangbusters. And within services, it was really just financial services and infocoms. Many of the other sectors were hit by the lockdowns, no surprise. F&B, retail, recreation, hospitality, all pretty hard hit, and they are still below pre-pandemic levels. construction was also struggling. So we're looking at some of the laggard sectors to start catching up this year with the reopening, with the high vaccination rates, and that should provide a lift. Manufacturing, unfortunately, cannot keep on growing at 20%. It's reaching full capacity, especially on the electronic side, especially on semiconductors. So you expect that to moderate. I think for Singapore, really the big challenge is inflation. Right? Inflation is going through the roof in recent months. Headline inflation heading towards 4%. Core inflation, which strips out private transport and accommodation costs, is heading up to 2%. Some of it is cyclical, so some of it might go away in the second half. For example, rising energy prices, oil prices. Transport costs is also going up with a few increases, the COE premiums. Housing rents has also been going up because of all the project delays. And of course, the borders have also tightened the foreign labor, right, which have raised that cost as well. But there are also structural forces at play that I think we have to watch out for in the second half. September this year, the government will be introducing the minimum qualifying salary. So it'll be pegged at 1,400. That affects about 9% of the labor force, which will see high in wages. Will that pass on, to overall inflation? In September this year, the government will also be expanding the progressive wage model, which kind of, ratchets up the wages for certain sectors. This time it'll be expanded to retail. Next year it'll be expanded to F&B. Retail will cover about 20,000 workers. F&B will cover another 80,000 workers. And of course, we have to watch out in the budget because if the GST hike does materialize this year, that could add more pressure on inflation. So I think it opens up big questions about how the inflation will play out this year, which also means that the central bank, we think, will have to tighten again at April. And there's a risk of a double move, meaning they will not just steepen the slope of the appreciation bias, but they could also recenter the whole band upwards. I think the other action to watch out for in Singapore this year is the labor market. So there's some interesting things going on in the labor market. You would have thought that over the last 2 years during the pandemic, about 200,000 foreigners has actually left the country. These are not just your blue-collar construction workers, but also some of the employment pass numbers, have also left the country. So to me will they come back? Because if they don't come back, there's clearly going to be a supply side constraint in terms of a manpower crunch. And that will probably mean that firms, even though its demand is strong, they may not be able to capitalize on it. If they can't invest and expand and get the headcount they need. The other interesting phenomenon is the return of overseas Singaporeans, because that number, before the pandemic, there was about 200,000 Singaporeans abroad. About 30 to 40,000 have come back over the last 2 years. No surprise. That's probably one of the explanations for the fairly resilient property market as well. We'll see how this plays out this year.
Thank you, Harbin. It seems like the Singapore economy will continue to do pretty well this year. So, Eddie, how will Singapore equities perform in 2022?
Right. If you look at the SCI Straits Times Index, it has appreciated about 10% in 2021, but we think there is still further upside to the index. Right. As Harbin has mentioned, Singapore's GDP growth, I think it's still going to look quite robust, and that is going to be supportive of earnings growth and consequently drive market returns. Now, in particular, we see 3 areas of opportunities. One, in terms of reopening, we believe retail and hospitality services will benefit from further reopening of the economy. Now, already I've received 3 wedding invites this year versus 0 last year, right? On top of that, transport services like airlines, cruises, or even your public transport, MRTs, buses, will see increased passenger volumes. Now, secondly, we believe that the banks will benefit from the rising rates in terms of interest margins. And on top of that, because of the healthy macro environment, I think that will be supportive of loan volumes, growth, as well as fee income. Now, thirdly, in terms of restructuring, we are expecting to see further restructuring activities, be it within the Temasek-linked companies, or perhaps potentially in the plantation sector, that could help to unlock additional value and boost overall share price performance. Now, in addition to these 3 areas, we continue to see or view Singapore REITs as an attractive income play. Right? If you look at Singapore REITs, they are still offering an average dividend yield of about 5 to 6%, and it's actually at a reasonable spread above government bond yields. And unlike bonds, which are offering fixed coupons, Singapore REITs can actually grow their income as well as dividends, and at the same time enhance their asset value so as to mitigate against the negative impact of rising rates. So I think for investors looking to hunt for yield, to enhance or add some stability to their portfolio returns, I think Singapore REITs remain as an interesting option.
Thank you. With expected healthy economic and earnings growth in 2022, are we expecting a stronger Sing dollars too, Andy?
Hi, Alexis. Yeah, so Sing dollar, we are actually positive for 2022 based on various factors. But maybe we can talk about this living with COVID strategy. I think Eddie and Harbin mentioned much earlier just now. Living with COVID strategy in Singapore as we go into endemic scenario. But if you look at, for example, if you look at the plot of a Oxford COVID Stringency Index, which is looking at the various measures, restriction measures that were introduced in countries like Singapore, for example, since last year, whenever the restrictions were tight, Sing dollar will weight down, so Sing dollar weakened. And when restrictions were eased, which was more recent as we moved into the endemic scenario as well, Sing dollar strengthened. So as we go into living with COVID strategy and endemic scenario where restrictions continue to be eased globally and also including Singapore, I think we expect Sing dollar to continue to be stronger. There's also the fact that I think despite the Omicron concerns and COVID wave concerns, the vaccine progression that we've seen in Singapore and all have actually increased substantially, and potentially those are actually positive on the Sing dollar. But if you look at MAS's policy normalization, that's another factor that would continue to provide some support to the Sing dollar and some net positive for Sing dollar. If you look at potential inflation concerns that the central bank have and how they would move in coming April, we could potentially see two scenarios. One scenario would be the fact that they could steepen the slope of the Sing dollar near. Currently, our model in the my FX team is we're expecting the slope to increase potentially from 0.5% per annum to around 1% per annum.
What are the key factors to consider when evaluating sustainable investments? Eddie, can you share with us?
Right, Alexis, sustainable investing is indeed gaining traction, right? And we believe that it's going to play an increasingly important role in portfolio allocation, right? If you look at the latest data from Morningstar, global sustainable fund assets have hit a record high of 3.9 trillion as of third quarter last year. And that expansion has been particularly sharp since the onset of the pandemic. Now, despite this impressive asset growth, there are still some concerns over a lack of a common standard to evaluate sustainable investments. So this has kept some investors on the sideline as they are worried that investments that are labeled as sustainable are in fact greenwashed or creating a false impression that they are ESG friendly. So to address these concerns, there have been regulatory developments, such as the introduction of this sustainable finance disclosure requirement in Europe, which makes it easier for investors to compare the sustainability profile of different investment funds and fund products, right? And further progress on this front, regulatory front, I think that should help instill investor confidence and drive inflows into sustainable assets. And notably, if you look at sustainable invest, if you use the MSCI World Socially Responsible Index as a proxy, sustainable investments have actually delivered robust returns over the past 1, 3, and 5 years. But I think one point that I would like to emphasize here is that having a good ESG rating alone, I think that shouldn't be the only criterion when you evaluate sustainable investments. I think we would suggest investors to consider other aspects, be it the track record of a sustainable fund, the credit fundamentals of a green bond, or simply just the share price valuation of a plant-based food company. So by adopting this holistic approach, I think we will then be in a better position to assess and select the appropriate sustainable investments to help future-proof our investments.
I think, Alexis, if I may actually add on to what Eddie has mentioned, there are opportunities also even in the FX markets. And if you follow from what Eddie has talked about sustainability, I give you an example. For example, in the EV market, the demand for transition metals such as lithium and other transition metals that comes into production of batteries in EV vehicles going forward would mean that some of these raw materials would need to come from countries like South America, even in ASEAN and Asia Pacific region, Australia and Indonesia, which have actually pockets of nodes of lithium that may increase demand of the raw materials or exports from those countries. So the reallocation into commodities related FX like Aussie and IDR rupiah might see some support for those currencies. So there are opportunities on the FX front as well.